Hey traders, welcome back. So in this video we're talking about what's known as a fat finger. What is a fat finger? Well, if you've been watching recently, you would have seen the gold fat finger. I'm going to put a little screenshot up here. And not too long ago as well, we had the GBP fat finger, and I'm going to put another screenshot of that up here. Well, that was all caused by somebody placing the wrong order, the wrong quantity, the wrong size, the wrong volume, anything that's wrong. And it's called a fat finger. So just imagine that somebody's just putting their finger on the execution button and they just press the wrong thing. You know, they've got a big finger, they're pressing the wrong value, they're pressing the wrong volume, they're pressing the wrong way, the wrong size, anything like that. So that's why it's called a fat finger. So most of the time, these things are safeguarded at a broker level or an exchange level. So obviously these are caused by generally investment banks, hedge funds, people who've got access directly in to the exchange. So the broker doesn't really have chance to stop it. But if you and I were to put in an order for, you know, 1 million shares of something and we didn't have the funds in it, immediately it's going to put up an error. It's going to say, no, you can't do that. You don't have the funds in your account. But if you did have the funds in your account, it's going to be circuit breakers that within the broker that say, hey, are you sure about this? You know, and there's also things I know with some of the other brokers that if you've got a larger size, it's going to say, hey, and these are things that you can change in the platform as well. Hey, do you know what, you are trading way above the market price here. Are you really sure you want to execute this? Or this is unusual size for you. You're trading kind of 100 times the normal size. Are you sure? And you get that pop-up thing. So if it is a genuine mistake, you want to go, whoa, it's a mistake, and cancel it. Now, obviously from a broker level, i.e. or a hedge fund level, or someone who's a little bit more advanced, they don't have these kind of circuit breakers, or not circuit breakers, wrong terminology. We're going to talk about circuit breakers specifically in a minute. They don't have these kind of fences and gates to keep them in. They do have some things, but of course they have reason to be trading large size very often, and they're going to put that into the market. They're going to work the order. They don't want these restrictions on them, so they tend to have, these are the ones that sometimes tend to be the victim of the fat finger. So someone's going to come in, they're going to sell a basket of contracts, and normally they would do it and they would kind of work it at the order. But perhaps if the fat finger part of it is they put in just a market instead of a limit, and instead of a limit, an algo is working, that just sweeps the book overnight. So in that instance, they haven't got the controls in place. Now, exchanges are usually going to stop this. They have what's called circuit breakers, and this is where we're talking about actual circuit breakers, what was in my head earlier, is that if a price moves a certain amount in a certain period of time, in other words, a big move in a short period of time, it's going to get locked off. It's going to stop the market, and the circuit breaker is going to kick in, and nothing's going to happen. So if you're on a thin book, a US stock, UK share, and you're hitting bids, all of a sudden the bid goes, 10% below what the market price, and someone tries to trade on that, then it will go into an auction period. So there are these circuit breakers, and the same, if you recall back. How long ago was it? Anyway, not very long ago, we had the ES hit limit down overnight, and we have some of the soft commodities hitting limit up. These are kind of circuit breakers in the day. Not the same as a fat finger, but you've got these things that are based on exchange. Now, interesting to think is that the bigger the damage, or the bigger the fat finger, the more likely the exchange is to reverse the trade. Now, if you look back on some of the fat fingers that we've had before, and in fact I've got some here that I want to talk about. Here you go. 2001, UBS sold 610,000 shares at 6 yen instead of 6 shares at 610,000 yen. Wow, what a mistake. So basically, in this case, the error was spotted immediately, but the Tokyo Stock Exchange didn't cancel the trades. UBS had to buy them back, and it caused them a loss of $100 million. Youch. But then if you look at, there's one here. Yeah, here we go. Look at this. This is one in 2015, a junior guy at Deutsche Bank. His boss was on holiday, and he confused some amounts. Anyway, he put a trade in. He ended up putting the wrong amount in. The bank reported the error straight away, and the trades got cancelled. So there are the ability, if it's an obvious large problem, then the exchange will cancel the trades and make everyone right. Now, it's annoying if you're on the right end of that and you end up buying at the bottom, but they're kind of protecting the banks, and you get why they're doing that. So What I wanted to talk about now specifically is, why does it do that? So if we get a fat finger and someone presses the button, why does it happen? Let's look on a granular level as to actually what's happening when a fat finger occurs. So if you can imagine, guys, and I'm not going to go into crazy depth with the market depth, but if you're familiar with the market depth, you've got to have the buy side here, which is the bid, and you've got the sell side here, which is the ask. In fact, let's use the correct terminology, because otherwise we're going to get confused with ourselves, aren't we? So we've got the bid here, and we've got the ask here. And you've got stacked up orders, so 101, 99, 50, 2, 10, and then on the ask side you've got 50, 44, 13, 203, and then here you've got your price. So your price is going to be, let's just say, it's 99, 98, 97, 96, 95, and this is 100, 101, 102, 103. So there's your kind of really, really rough market depth. Trying to just do it quickly, but you get the idea. So there's your volume, there's your price, there's your volume, there's your price. Now, fat finger, why a fat finger causes such damage on the charts? That someone comes in and says, hey, on that example there where he's meant to sell 6 at 610,000, instead sells 610,000 at 6, you can imagine that order coming through. If you say, listen, I want to sell, that kind of big number, what happens is someone comes in, let's say someone wants to sell 50,000, right? Comes in, he puts 50,000 to sell in by accident at market. You're going to end up taking that level, that level, that level, that level, that level, and all the levels down below until you complete your 50,000 order. So the price is going to, on the chart, is going to be sitting here doing this. All of a sudden go poof, go down to whatever that may stop at, 40, or if the circuit breaker kicks in or whatever. The point is to go about that. Then you'll have this liquidity vacuum where there'll be nothing there. People then will start to bid up thinking that's ridiculous. You'll then start getting prints up around here, because people will be bidding on 50s, 60s, 70s thinking, I know it's a fat finger, I want to see if I can get some value here. There'll be a few sort of loose trades done here, and then eventually you'll kind of trade back, or you might even sort of stop there while people kind of work out what's going on, depending on the time of day that happens. If it happens in the middle of the night, sometimes there's confusion. People think, well, is it genuine? What's happening? Often we have to have kind of an assessment, an analysis of what's happened, and they dig down and find who's done the trades and who's done what. But it's kind of self-fulfilling as well. I'll just talk about this point briefly, guys, is that, if someone is selling these levels and clearing out these levels, often algos and other people who are watching this thinking what's going on, then they're stepping down these as well. So algos that are going best offer then go to 99, 98, 97, that gets thinner and thinner and thinner, and it's kind of self-perpetuating sometimes. You've got to be very careful that it doesn't cause a cascade, because if you get that and other algos are self-feeding on it and selling, and also market making type algos that are caught long are going to then look into selling to the lows, and that's kind of what happened with the flash crash. Even though it was a longer time period, algos were then selling to get rid of some of the stuff that they had, the inventory they had. So you've got to be careful with that. But generally speaking, fat finger is someone making a big mistake, wrong size of order, wrong price, or any of those two parameters, both or either, sticking it in with no broker or order entry level circuit breaker, hammering the market, and then you see charts like we saw earlier, big spikes one way or another that generally resolve themselves, and you can get caught out with it. If you're not careful. It's one of the dangers of using kind of stops. Sometimes you can get stopped out of it, but if the trade is subsequently cancelled for the other counterparty of the trade, yours will be cancelled too, so you'll be made good if you're on the wrong end of it, or you'll be made bad if you're on the right end of it and happen to have a limit down below. Give it a thumbs up if you like this video, guys. Don't forget to subscribe, and I shall see you in the next video. Take care.